Hello and welcome to another edition of the Moving Iron Podcast. This podcast is proudly provided by Axon, helping dealers move more iron for almost 100 years. Find out more at agmarkets.com. Axon was started almost 100 years ago out of a passion for keeping agriculture moving. It's that same passion that drives them today. With a vision for a better experience for both farmer and dealer, they set out to create a better way to move more iron. When you partner with Axon, you get immediate access to a full range of products and solutions designed to meet the complex needs of today's grower. Axon carries all major brands and sizes of tires, wheels, and tracks. From custom colors and sizes to fully customized wheels, you can have the solution for virtually any problem today's farmer is trying to solve. To find more or become an Axon dealer, please visit agmarkets.com.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving iron.
Hello and welcome to Moving Iron Podcast number 206. This podcast is proudly provided by Axon, helping dealers move more iron for almost 100 years. Find out more at agmarkets.com. Also, TractorZoom, delivering insights, and they've got a product called Iron Comps, and I use it pretty regular to see what's going on in the auction marketplace. It's a great way to see trends develop and see what's upcoming auctions and what they look like, what how many machines have sold, what's the inventory look like. Great way to develop trend lines. I use it all the time. So if you're looking to use that Iron Comps and get more of a feel for what's there, use Moving Iron at checkout and you'll get a discount. So this week's guest is Rich Posson, and Rich Posson is someone I love having on the podcast, man. He comes with a ton of information about what's going on in not just the U.S. marketplace, but across the United States, Canada, all the rest of the world too, and really just kind of dives in to what's really driving the marketplace. So Rich was kind enough to come on once a month, sit down with me, and talk about what's going on. So Rich, I hope you're doing all right. Looks like you got some of that winter storm that came through by the foot.
We did. We got a foot. They told us 3 inches, and we got a foot. So.
Yeah, so give or take, right? Plus or minus, right? That's how it works, right?
Yep.
Well, Rich, there's no lack of things to talk about here, man. There's a million things going on. We've got a lot of volatility in the markets. We've got a new president that's cranking out the executive orders as fast as he can get them out there, and there are plenty of things that have changed across the landscape from what it was when Trump was in office, as far as regulatory approach to things and what we see happening there. So the one thing I want to spend a little time with you on today, a question I get asked a lot, guys, in the farming community that are not so much worried about 21 as much as they are 22, 23, and 24. What's that long-term cycle look like? And the thing they bring up the most in that long-term cycle is interest rates, and what does that look like? And with the amount of money that's being pumped out there by the Federal Reserve, and there's really talking about another $1.9 billion worth of, or not billion, $1 trillion worth of stimulus to come down the pike. Again, what's your thoughts on interest rates as you kind of look out across the next 3 to 5 years? And do you see something from where we're hanging out now at 0 to the Fed coming out at 3.5% or 4% or something like that the next 5 years?
Yeah. So for the next 4 or 5 years, I think the trend is up for interest rates. I feel very comfortable. I think I might have been fortunate enough to have called a super cycle bottom in interest rates in August relative to the Treasury type products, such as the 10-year note, 30-year bond. And I think the trend is up the next 15, 25 years. Now, if you dig in the side of commercial debt, you'll find some interest rates are actually still going lower. It's going to take a time. It's a process. So I think I called the bottom on the Treasury side. It may be a little different on the commercial, private money, corporate bonds. But ultimately, I think they will come on board. And I see rising interest rates the next 15, 25 years. The most of the rise in terms of any kind of surge and very high rates will wait to sometime next decade. I'm convinced of that. However, Rates have gone down for 40 years. We've gone to zero. We've had real nominal rates below that. So, it should not surprise us to see the 10-year note that's bumped up against 1% or something like that. I don't know if I can bring that quick on my computer, but we should not be surprised to maybe see the 10-year note run to like 3%. And I'm trying to still bring that up. So, and to me, that sounds like still a low rate. I don't see a reason to get scared, but it depends on everyone's personal amount of debt and whether they've locked in rates. And in fact, I can see for the 10-year Treasury note is up at 1.07%. So 3% is going to put rates back to around the 2018 high.
Okay.
And I think that should be normal, very achievable, plausible if the economy is growing. And I'm very convinced the economy is going to grow. We're licking this virus thing and another great recession, as some people are calling it. And rates should go up as an economy grows. And you should want rates to go up soon after the recession's bottoming out to kind of prove that. And I think that's what we're doing. We're getting some proof from the interest rate market. So one has to ask ourselves, can it go really to 3% in 3 years? Well, we went from 1.4% to 3.2% from 2016 to 2018. So it certainly could maybe not get quite that high this time around, but, it ought to get up at least 2.8, 2.6%. So you have to look at your own personal debt if you're not locked in. I'm very convinced on this super cycle stuff. I'm not saying in the next 15, 20 years, there won't be times we bring rates back to 0% because you're going to get a recession every decade and you will bring the rates back. I'm just saying this bigger trend, however, is going to make for better recoveries, and those future recessions could possibly not be as severe. And you may not see it come all the way back to zero. And so frankly, I'd rather have my rates locked in and know what I got rather gamble on getting still lower rates.
Yeah. I just bought a house, so my interest rate was, I can't remember what, 2 3/4. That's what it was on a 30-year fixed note, and that's cheap money. And that helps fuel a lot of things,
The way I look at it, even if government rates are rising and for some strange reason commercial rates keep coming down for another year or two, that's probably about it, and then they'll be up. And I just see limited downside from here if those other types of rates are coming down. There's more upside potential here.
Okay. So let's talk about the strength of the dollar a little bit. So the dollar has been kind of back and forth. We talked about last time you were on here, and you had mentioned that if the dollar got below 88, that there could be some opportunities for some very inflationary type events to take place. So talk about what you see the dollar's at right now, and then how is that fueling what we see happening with, the exports we see guys that are just, getting out of the country as fast as we can get them out of here.
Yeah. The dollar, at least the model worked well on the dollar. It said it ought to start turning up this month, and it should be up into next month. It should top out next month, be back down in March is what it's forecasting. So apparently it's warning us this is going to take a few weeks here. For some reason, they got to adjust their positions, and we can have a stable to somewhat higher dollar. But I don't think the dollar index goes to 92, but I'm allowing as high as 92, and it's currently at 90.54. Looking out March and more so into May, June, July, I think the dollar goes to a new low. It's going to take out last year's low. Now, the dollar came down a considerable amount, but we're still in a long-term bear market. And so, I'm not saying I can catch every little fluctuation along the way correctly and get some of the price levels correct, but basically I think we have lower to go. I think we'll see that 88 to 85. I've been using that for 10 years now, saying that's got to be a good level to help out exports of goods and services and help out the economy. And frankly, I still say it works opposite of what everybody tries to teach on the global scenario. I think a lower dollar actually helps quite a bit of the world, even though in theory, in the math, it shouldn't work that way. But my goodness, I look at the evidence and saying, gosh, it looks like it does work that way sometimes. So to me, anybody on the global scene, I don't think you have to be turning pessimistic necessarily just because the U.S. dollar is going lower. And I do think we need a little better competitiveness. I think we've helped the world get better over decades now. And yes, I think things are a little out of line, and I think the free market system is trying to correct that, get the dollar down there in better balance with the rest of the world, and that'll help us. Is it going below 85? A lot of people thought it was going to crash this year. I haven't heard any more updates from some of the banks that were saying that. It may, but I'll just be pleased if it goes to 80, 85 this year. And even if it doesn't, I think the next 4 years you could see the lower dollar, and that's quite possibly going to help inflation the next 4 years and help interest rates go higher in the next 4 years. Now, I realize currency people will say, well, wait a minute. Currencies have to be highly connected to interest rates. If you got higher interest rates, you have stronger currencies. The problem is you got to remember it's global. So It matters if our interest rates are going up, but they're not going up as fast as interest rates in someplace else in the world, then our dollar will not rally as far relative to those countries. So we can keep the dollar going down because they're more excited about buying other currencies that are going to go up faster because of their interest rates are perhaps going up faster, or they're already relatively high. So it gets a little more complicated. So I'm not concerned of higher interest rates in the next 4 years propping up the dollar on us. I think there's too many other things going economically here. And I think also the dollar traders watch anything and everything they possibly can. Even though they might be interest oriented, they are close watchers of inflation. And if they think they're more accurate or more concerned of low inflation, they're going to discount their bullish interest rate factor as bullish the dollar. They're going to discount that. And they're going to favor, their bias is going to swing over to saying, hey, sell the dollar if inflation's going higher. And I think that's going to be the primary story for them. So bottom line is, yes, I'm still long-term bear dollar. Yes, we'll see times it's going to pop. And if it pops fast, that may cause some issues over in commodities at times, maybe even the stock market, because I'm convinced the stock market would prefer at least a stable dollar at these levels, if not a bit lower. It would like to also see our exports keep moving for us here.
Yep. Okay, so let's talk about energy for a little bit. Joe Biden came in, kept his promises, said he's going to shut down the Keystone Pipeline. They did that, and they've taken away a lot of the leases and stuff on federal ground as far as drilling goes. You start looking at the pipeline situation and not really expanding any pipelines or updating pipelines as they come along. You can start seeing a lot more pressure being put on the rail systems as you start looking at more and more refined fuels and more crude oil getting shipped around the country via truck and via train. What's your thoughts on that? And then what's your thoughts on if he puts a halt to fracking, like he's talked about doing? What's that look like for energy, and then kind of what's your 5-year outlook on energy look like?
I think at least crude oil has put in the lowest price we're going to see for several years now. But I also think crude oil is very limited to the upside, maybe for many, many decades. Eventually, I think crude oil will go out, and I'll explain that in a moment. But for the next 5 years, I think there could be some support there just because the economy is going to grow. We're going to see better demand. We're going to see greater gasoline consumption. It can be argued we're coming online with these electric cars so quickly. However, maybe it kind of limits the upside of that. So right for the moment, like I'm looking for this year, maybe crude oil can work up to $60. I really like the trend on the WTI right now, crude oil futures. It is a quiet trend, which I might make some people concerned that it's topping out, but normally in commodities, top's kind of a volatile, noisy situation, even in the stock market for that matter. So I'm actually looking for a little setback in a few weeks in crude oil, but as I zoom out towards Memorial Day, I think gasoline heads higher than Memorial Day. Crude oil has a history of not staying up that long, but it can stay up for a fair portion. So bottom line is, I really don't see crude oil under $30 anytime now. I think $60 is going to act as a top for a while. And I think there's a little more upside near term here in crude oil. Looking out 4 years, can it go over $60 the next 4 to 5 years? Yes, but is it going to 80, 90? I don't see it. Maybe it can do that near the end of the decade when the economy should be at its best, but also peaking. And maybe crude oil picks up on that or something. But now let me talk a little something long term, because I just put out a special report a few minutes ago here. People have been really bugging me of talk the next 30, 40, 50 years, and they're just fascinated with what I've been digging up. And we just come up with a new alternative model that I think is going to be the number one model for the economy and stock market. And the other model will become a very close second, and we'll watch both of them at the same time. And what that model is suggesting is that, yes, there's probably trouble coming in the 2030s, 2040s for the stock market economy, probably commodities. We could even see commodities fall 30 or 60% if stocks want to fall out of bed by a serious amount. There's all kinds of issues that can go on there, and we could talk about more of that later if we have time or put it on another time. But what I want to point out is I realized that even though all this modeling over the past few decades was saying crude oil should reach a record high in the 2030s, I also realized fundamentally and economically it couldn't do it or shouldn't do it. So the model has its own argument going on, saying if we look at the business cycles, how prices behaved ever since 1890s, believe it or not, in crude oil, it should be a record high. Problem is we're bringing on these alternative energies so quickly that it's going to limit the upside. So I've thrown it out. I do not see a record high coming. And eventually, decades down the road, maybe hundreds of years down the road, I wouldn't be surprised crude oil staying in the ground. Natural gas, eventually doing that. Coal may very well be out the door sooner than even crude oil. Now, before some people say, that's crazy thinking, and nobody can forecast that way out. Well, here's some issues to think about. And we have hydrogen that I think we produce $118 billion around the world of hydrogen, and that's really nothing in the energy world. But there's going to be greater investment dollars. They're figuring out ways to make that more productive, more efficient, lower cost, and I think a big boom is coming. Well, I didn't see Bank of America's report. All I saw was the headline, and headline said by 2050, 25% of crude oil or energy consumption related to crude oil would shift to hydrogen. Well, that's a significant change. You're basically saying we're going to cut the crude oil industry by 25%, and it's going to be in this new industry of hydrogen. By the way, that could, way down the road, cause problems for ethanol, so we have to keep that in mind, and corn. But these things are going to take a while to come on. So these are not issues for the next 5 years, okay? But it does send a message we're kind of on the right track of let's not get really bulled up on crude oil over the next few decades, all right? And we also have the fusion and making electricity from fusion. Well, they discovered fusion, but it's way too expensive. They actually can make less electricity out of the inputs into fusion, so it's a net loss or break even. But it's many scientists think this decade they'll have the breakthrough. And if they get the breakthrough, I say in 2030s, you're going to hear this rushing sound of investment dollars in to create fusion and produce electricity. It's going to be a big, big game changer for the rest of the century, lots of electricity. And now we have General Motors coming out saying they want all of their car production to be electric by 2035. Now, what I don't know is, was that hybrids and pure electric or what? But that's going to make some impacts too. So we got to be cautious here when looking way out. I don't think the future looks that bright for crude oil. But is it over and done and we're stuck with $50 to $30 prices all this decade and on and maybe eventually lower? No, I wouldn't be surprised we can get some spikes over 60. But I don't think we're going to see $100 oil ever again. So you could use this as guidelines of just how one wants to protect their energy prices as inputs. Or if they're speculating, it seems to me you want to be more of a short-term, intra-year kind of trader. You don't buy oil and set on it for a very long time.
Right. What do you think about when you're looking at what we see happening in the stock market right now and what we see happening in the commodity markets, these huge volatile swings that we see happening right now? So you see like this GameStop thing that's going on right now, the stock it's gained $100 every day for the past, I don't know how many days it's been doing that. Yeah. But you see that kind of stuff happen there. You see corn and soybeans where you have, especially soybeans, where you'll have like last week, for example, I think soybeans lost $1.30 or something like that across the week. They've gained the majority of that back. Thursday was a rough day for soybeans yesterday. I haven't been so busy today. I haven't seen my ticker for the day yet where soybeans are at, but you've just seen these huge swings, even in the corn market. We'll see 5 and 10 cent swings in the market all day long. What's driving this volatility that we see across the board?
Yeah, it's a big money moving around, and what it is they're starting to break up. They've been very bullish since August in the grains. They started to get bullish last summer when they thought there might be a little weather problem. Then they got it wrong. They gave up on it when it was actually still occurring. And then in August, they started to get the USDA data, and they got on board, and they finally they've been betting on the idea that, well, if Biden gets elected, doesn't that actually increase the odds we're going to get this inflation? And no matter who gets elected, aren't we going to have more inflation because of all this money printing? And they just really jumped on everything. They had their macroeconomics finally bigger and better than ever in the inflation story. And then they also get some weather issues, and they look at the S&Ds and saying, oh, it's tighter, and this stuff has been too cheap for too long. And it just came to make a perfect storm, if you will, okay? Now, the problem is when commodities like corn, soybeans get extremely high, have had a very lengthy bull run like what they've had. Eventually, you get people saying, all right, I got to take some profits, but if I'm wrong, I'm willing to jump back in. And so what they're really telling you is they want to become shorter and shorter term traders. They're concerned the bigger move is about over, but they're concerned nobody can predict it. And so they get a little uneasy and they start trying a little bit of different strategies here and there, and they're going to trade faster and faster. And that's what occurred. And what was it, last week? I think it was corn or beans took that dive down to $12.98 in the March futures.
Yep.
That even threw me off because my model was saying, oh, it's going higher later. And my risk management stuff kicked in and said, okay, you just got to temporarily give up on that idea and acknowledge this heavy dose of selling. And I think that's what was going on with everybody else. I think the risk management stuff got a little too close to the market, and they were selling for just the sake of selling. They were selling to make sure they preserved their money. They weren't necessarily analyzing, oh, this should go down now. And I think it caught them off the guard. And then this Monday, I come in saying, well, maybe they've damaged the market. Maybe it's going lower late in the week, but, we got to be cautious. This could have been a little fake out, back up. By Tuesday, I said, gosh, this thing, I think they're literally mad that they sold the prior week. And so they're just rushing right back in. And I set up new objectives for a new high for the year in corn. And the rest was history. It went there, okay? And I really do think it threw some people off, and I think they were just downright ticked off and just rushed right back in again. It's not the best of thinking. It's normally a sign of coming to some kind of top. So I do think next few months, there's got to be some kind of consolidation and correction in these grains. I think it's getting kind of high priced, but at least going into the end of the week here, I was still of a bullish mind in the corn, frankly. And we got that ethanol news, made EM China, kind of excited the corn market. So corn's now a little bit of the leader when soybeans are the recovery, but they haven't gone to a new high for the year either. And I think soybeans giving us a clue that a lot of this bullish news is pretty much dialed in. And I did warn people back when the USDA report came out. I said, we got what we wanted. It's bullish. But you know what? We've had so many bullish reports since August. Pretty soon, people are going to look at the statistics saying, you know what, we're due for maybe not for a bearish report, but how much more bullish can it get? And how much higher prices, what else is going to drive this higher? And I think that's what's concerning the market. And that's why it's getting a little choppy, a little slippery in here. But at the same time, they haven't done enough damage to say, hey, it's all over, Right. But I'm watching for that. I'm looking. I do think it's time, time is coming to set it back. Now, how about it going into summer? I'm not suggesting that it's going to be all over for the rest of the year. It could be, but I think come summer they're going to have to get a little nervous over weather, because I don't see how we adjust the S&Ds enough to say, hey, those are big enough crops out of South America. Don't worry about it, And you can see that the global markets right now, they were watching Brazil and U.S., and now they're leaning a little more towards the U.S., which is actually a little bit stronger than Brazil right now, especially on the corn, okay? So very interesting setups, and I think it's fascinating. It's kind of it's fascinating how the grain markets and stock market were kind of on the same page. And a lot of other commodities are on the same page. I also covered cotton and sugar and cocoa, coffee, and all those. And earlier this week, or for months now, I've said, isn't it fascinating? Some of these fluctuations are kind of about the same time as stock market. So you're seeing this macro across-the-board portfolios here of, hey, we want some commodities. We'll trade them in either direction. We want stocks, that kind of thing. And so what's going on in the stock market? Well, here again, it was time for a top in the stock market, and I called it this week. I was a little hesitant early in the week, but today the market's down pretty good. I think we got the evidence. We'll be warning when it's going to be the next great buy in the stock market, so we'll keep an eye on it. As far as all this news in the stock market in terms of the retail investors versus the hedge funds, and you probably hear of the Robinhood traders.
Right.
They're basically using the Robinhood app. Well, I've been watching some of the young people, and of course, my daughter is that age, is trading those kind of stocks, and she's all for it. Who cares if we cause trouble for the hedge funders? And I must say, some of the complaints of where they try to want to shut these people down, they want to try to rig the free market system here in the stock market, that's upsetting to me a bit. At the same time, yes, they've been too bullish. They've shoved some of those stocks way too high. But, sometimes the hedge funds and the professionals shove things way too high. And I think we have to realize that these young people using something like Robinhood, which Robinhood, the only way they make money is from selling the data from their customers, because they don't charge commissions. So the point is, they're selling the data to let everybody know what their customers are doing, not individually by no means, they're private. But I'm just saying, they let people know, well, they bought this stock for the last 3 days, they bought X amount. And so some of these funds go out and buy that data. There could be some of the retail investors could be buying it. If they can't afford it, I bet they group up and buy it. Okay. And I just think the young people said, something, some of these funds, they'll be 75% of the stock, they'll be shorted. That's bizarre, because normally you take, let's say your company is 1 million shares. Normally you might see short traders get up to about 100,000 of that. They get up to about 10%. That's about it. And these days you're seeing some of these hedge funds really beat up on some of these companies because they just don't think they deserve to exist. And is that fair? Is that correct? And so I think these young people are looking at it saying, yeah, but some of these hedge funds are really not very good at it. Everybody keeps praising them, how they're the smartest, the best, they work harder than everybody else. And I must admit, the track records aren't that great. Okay. So I think they're thinking, these people can be wrong betting on the downside of these companies. And I think they've learned how to figure out, create an indicator and create a method to trade that and go against those big guys. And in my opinion, they're not really doing anything wrong. It's data that is available. You either pay for it or you get it free, but it's available and it's legal. Okay. Right. And so they're just trying to do their best with the analysis. So why do you pick on them when we've known for years the hedge funds are very secretive and they're out there digging data, that trying to find something nobody else has? So I'm kind of with the young people on this, even though I think they've overdone it and they make these stocks go up too much, and understand that can cause some problems. At the same time, I feel like I don't think it's necessary to come in with new regulations and mess with the free market system on this. I think there should be a better way to work around this. All right. And yes, the young people will probably get clipped, but some of them made money. I just saw on TV a guy was saying, well, my son, he made 50,000 and he just took it out of the market. He didn't lose it all, and he just bought a house. Well, great for them.
Right. Right. Yeah.
So it's sad to see this. It gets very political, and it is a war. I mean, some of these young people, they if you watch how they tweet and they're chatting, they do act a bit vicious, and I don't think that's correct. But you know what? That's kind of the American way here, unfortunately, at the moment. But I think overall for the stock market, I don't think that's really going to cause problems for the entire market. It's those individual stocks, but I could be wrong on it. Some of these brokers that are trying to hold back, they're worried about their own money that they have to put into the business, and can that cause problems? So there's issues that will be studied and probably should study, but I hope they don't go too quickly here and slap everybody on the wrist when it was quite possibly not necessary. That'll all work out in the end. But nevertheless, for the overall healthiness of the stock market, yes, it is kind of high priced. And again, normally when any kind of market gets high priced, it gets a little volatile, crazy, and down sharply one day and right back up again until it's finally put in some kind of top. Well, our market, the stock market's getting a little bit slippery here. I think it is topping out. I think we're due for a correction. But as I zoom out, the stock market should be higher the next 4 to 5 years. So as far as adding that to what we just said on interest rates, inflation, commodities, it just looks like things can be supported here for a while. And I'm just looking to buy the dip in the stock market. I backed out of some, took some profit, and I'll get back in, and I'll let my subscribers know what I'm doing and why I'm doing it and what kind of signal we have here. But I still see a very good stock market this next 4 years. And I think it's going to be staying up longer than that. I think we've got a whole decade, even though I realize there's people out there looking for a crash at any moment. And I don't mean a crash like what we saw earlier last year. They're looking for something bizarre as in 1929. Well, I just don't see it. Okay. And, but this new special report I sent out, I've been saying all along, the real disaster isn't coming to 2030s, 2040s. Well, this new model's saying it might come as early as the end of this decade. It also could come later than what I'm calling for, but it's also saying the highest probability is still late 2030s, late 2040s. So very pleased with that model, and we'll be discussing that. It's going to get very interesting the rest of this decade as we get closer to the day that I will say sell everything. But right at the moment, I'd rather take profits along the way, buy them on dips, and keep working this higher. I think we've got some good profitability. I'm going to be putting out another special report showing what did the stock market do per decade, going all the way back into the early 1800s, believe it or not. And it's just fascinating. I don't know if it has anything predictive, but just fascinating. I think what it did teach me is maybe this decade, the best the stock market can do is double. Well, that's pretty good money. So I'll take that.
Yeah. Yeah. Double your money. That's a pretty good day at the office. No doubt about that. When you take a look at, some other drivers of the economy, you start looking at different things like gold, for example. And then if you listen to Peter Schiff talk about what he has this incredible just idea that he can't stand Bitcoin, obviously. So, and I don't think there's a lot of people that kind of waver back and forth. And I don't know what to think of it because I don't understand it, but that's a lot of it. But you start looking at some of these other indicators of what you see happening in the economy, and you start looking at precious metals like gold, silver, copper, platinum, those kind of things, and what they're doing in the marketplace. There's no real indicator there. I mean, yes, gold got up to about $2,000, I think, earlier in the year, and then it's kind of settled back down into that 1,800 range. But there's no big swings that you really see. Some days are off, and those other things are there, but I guess as you take a look at gold and you take a look at some of these other precious metals as key indicators of the economy, how do those stack up in your models? And do you see any sign of, a poise for gold or anything like that to take off based on some kind of inflationary news?
Yeah, I think obviously gold's been corrected a bit here in August and October and basically moved sideways. And really, I think it's a fairly tame correction. I think it's evolved from some taking profits and wondering, did they do the right thing? And now evolving to, this could be a little higher floor price than what we had last time we bought gold. And maybe we should be prepared for the next run up. And so I think they're starting to nibble at it. I think they're doing the correct thing. I think we'll put a bottom in gold sometime in February. I think it should dip a little bit on concerns of the stock market in the next couple of weeks, but I don't know if it's going down a lot. And I think what it really did is from February of last year, or I guess on my chart, it's March on into August. I think it was just dialing in all this money printing, the idea that yes, we'll get through this virus, and then you got all this money printing, and there's going to be inflation. And now what they're saying is, well, we now need to see the proof for that working. So they took a little profit, and it's just hesitating, and it's just waiting to start seeing that proof. And my guess is gold will be higher later this year. I think it's going higher over the next 4 years, but around mid-decade, I think gold can top out well ahead of the stock market and economy. I'm not sure exactly why that is. That may be a sign, maybe the highest of inflation, the fastest pace, in other words, is going to occur over the next 4 years, and then it kind of tames down going into later in the decade. So I may return into a reluctant long-term bear in gold by mid-decade, but I'll probably try to be a super cycle bull into the 2030s, unless this new model says no, we do have this problem coming sooner than the late 2030s. But anyways, at least the next few years, I think gold's going over 2,000. I don't know if it's going all the way up to 2,400. I think some of my favorite people threw out 2,400 last year. as a target, but maybe a limit. And I'm kind of with that. But the gold bugs, they often talk of 3,000, 5,000, 10,000. Can't rule it out. Can't rule higher in 24. But I think it's just going to have a nice up move here in the next 4 years. And if it does better, great. So much the better. I do own gold here. It's a very small position, but I'm not going to. I'm risking even more than I originally thought because I think it's just consolidating. It's hesitating before moving higher. I don't think it's a start of a new significant bear market. My smallest long-term stuff did say, you put a top in August, but it's saying, you know what, you could put that minor long-term bottom in just the next few weeks, next couple of months, something like that. And so I'm focusing more on the longer-term cycles. Business cycles are saying there's going to be more demand for gold coming. And I think it just fits in with our inflation scenario. And I think the gold people are smart enough to recognize that even though interest rates are going up, that you want interest rates going up when you come out of a recession, because that's a sign you are coming out of a recession. You're going into a growing economy. So I think at first they'll view higher interest rates as a positive. And hopefully the stock market will as well. Yeah. But later, yes, interest rates will get too high and everybody will flip the other way saying, well, this is no longer such a good thing.
Right. Yeah. Yep. So let's talk about this from a U.S. economy standpoint, and maybe to some extent across around the world. This may be a similar thing to happen, but definitely happened in the U.S. Post-COVID, as things start to calm down and more vaccines and things like that are getting out, and more people are acquiring quote unquote herd immunity and those kind of things. More and more people are taking a look at some of the unrest that we're seeing in the larger cities, and they're saying, you know what, I'm going to move out of New York City and I'm going to go move to Charlotte, North Carolina, or Nashville, or wherever it is. And you're starting to see this move of income out of one area and into another, and what that takes to reestablish those economic hubs that we're used to having in these major 20 cities that we have throughout the United States. And then you start looking at building material costs and those kind of things, and how all that stuff is kind of working together. What kind of effect do you think that'll have on the overall economy? Not necessarily long term, but this short term, kind of a 5 or 7 year expansion as these population centers tend to readjust themselves.
Yeah, I think it's going to be a bit tricky in the next 4 years because, one, there's already been a rush to get out of these bigger cities. And so they've been buying homes. My family has a real estate business and farming business in upstate New York, and they saw a rush for people getting out of New York City. They were very, very busy in real estate, even though it was very complicated because you couldn't meet in person, and it's going to cause complications for closing. The point is they got them done, and they got business done. To me, it's obvious as we work our way out of this virus, that demand will probably back off. And in some locations, prices have already moved up too quickly here. So I think there'll be a back off. On the other hand, I think these people buying these properties aren't necessarily doing it, well, I just wanted to buy it for a year or two. You don't do that. You're going to hang on it for quite a while. Mm-hmm. And so I think they're bought and sold. They're going to hang on them. But I think there's going to be that mentality where other people may still want to buy later in the decade of saying, I'd like an alternative here of what I'm doing. And I think a lot of people have learned they really like working remotely. Okay, I've worked most of my non-farming career, most of my financial career here has been working remotely, even though I've worked some big firms and had to work in our headquarters at times, even global headquarters. But, I prefer working there. I think I do my best analysis that way. And I realize the managers of these companies are going to try to fight back saying, no, we got to keep people in the office here. And they're not going to let everybody do it. But I think we've turned a corner. I felt like we turned a corner decades ago, that we were on our way to more remote. But I was looking like it was wrong here about a portion of last decade when you started seeing companies saying, well, we want a brand new headquarters and pull more people into a central location. I think they're going to change their attitude on that. So I think there's an opportunity for people to try to make money as far as still trying to get people out of these bigger cities, do some business in the rural communities if you want them. So,
right, yeah, yep.
You know, sometimes you might say, "Well, I'd like the business," but on the other hand, so
is the juice worth the squeeze, right?
yeah, exactly. Yeah. So, but I do think we probably are getting close. The rush is about over in that regards. Now, that doesn't mean now that the entire real estate market is vulnerable. In fact, I'm trying to look up my one of my real estate indexes here, and I got so many things on my computer that I'm not finding it. But I'm very convinced that the real estate relative to certain indexes I follow, and it's mostly REITs, so it's investment kind of things where you're investing in shopping malls, office buildings, apartments, but it was due for a cyclical collapse, just like what we saw in the stock market and economy, and that it was due to turn up. And I think it's bottomed. I think we've seen the turn. And my guess is we'll see those kind of indicators do fairly well for the rest of this decade. You do have to be cautious. They can top out ahead of the economy and stock market, so they might not stay up as long. But I think there's my REIT index. Let me pull that up, make sure I know what I'm talking about. Yeah. So, this REIT index I'm following, it's kind of following with the stock market saying, it might dip here in the next few weeks, but later in the year, it should be higher. And the next 4 years, it should be higher. And it's probably going to be somewhat higher. I don't want to get too built up, somewhat higher going into later this decade. So to me, I don't see a problem that for some reason this virus has just trashed the real estate market. There's no recovery. We're going to recover. There's going to be opportunities. People are going to make some money on the way up on things. But I also don't want to get overly bullish because you have people that, their renters aren't paying them. So they've they've had their fingers burned a bit here. They're scared. They're nervous about their future. So are they going to rush right out and buy a new apartment building? Are they going to buy the one that's somebody wants to desperately get rid of down the street? They may not. So I don't want to impress upon people big money is going to be made in the next few years of real estate. But I honestly think, at least my indicators, very convinced we've seen the worst. Now the question is, how long does it take to build up? But somehow, some way, I think eventually real estate benefits from this growing economy later in the decade. It just may not benefit as well as it has, and it may not be as crazy as it was in the 2000s when I remember I watched my home triple in value in literally 30 days, and I thought, what the heck is going on?
Right.
And I'm not saying I don't think we're going to see anything like that unless it's a small location. That's the thing with real estate. You can always get those little odd things that happen due to location. But
right.
But I think the overall trend is, to me, there should be some value things in here in real estate that got beat up with this virus recession that someday we will get back together. But at the same time, I fully understand people are going to be a bit cautious how much they want to put into it.
Right. So there's been, on more than one occasion, I've listened to guys talk about the fear they have of a collapsing commercial real estate market because of people working remote now. All of a sudden, these big companies realize I don't need to pay $20,000 a month for this huge office space over here. I can get half of them work over here. So now we're going to get this $2,000 a month space, and all this big commercial real estate is going to be hanging out there that nobody uses. And some have referenced a very similar collapse to, kind of what we saw in the 2008 real estate crash, and how that affected the overall markets and those kind of things. Do you sense anything like that from this? Because I just think about places like New York City where there's less people. There's still a ton of people live there, but I mean, more people are moving out, more people working remotely. I mean, I guess what's your thoughts on that scenario?
Yeah. I mean, some of those multi-million-dollar apartments, man, they're down like 30, 40, 50%.
Yeah.
And it was, it was overdue. I mean, it was getting ridiculously out of hand. They should have known they had that kind of risk. And it was just a matter of when and what would cause it. And now we know. And now it has occurred. Now you have to think the other way, saying, well, there should be some value there. Maybe that's a buy. Problem is, just as I said, I think a lot of people are going to be very cautious and nervous. I'm less optimistic or bullish on the commercial side of things. I think I want to be careful I guess I better clarify what I mean by commercial. I guess I'm concerned over shopping malls. I'm concerned over hotels. I'm concerned over the bigger apartments and big companies owning huge amounts of apartments. To me, it's the smaller stuff that's going to recover better. And I think the bigger stuff's got problems, and especially office space. I realize a new company would be looking at it saying, gosh, it looks like a nice break there. I could buy this or lock myself in on a lease. Well, yeah, you just, like any other day, you got to look at what can you afford, what's your risk. And if you come up saying, your business is going to do well, buy that office space because you just got a break. And I think eventually it does go higher before it breaks again. And it's always had breaks at some point. And so you just dial it in with your business plan and see if it works. But as an investor, would I just go rushing out there now and buy up office space? No, there's more ways to make money.
Yep.
I'd rather just be in the stock market itself.
Right. Exactly.
I can get out of the stock market very fast. Some of this real estate, I've made good money in real estate. I've had times where I made 100 and 150% just a single year in real estate. Problem is you can't do that very often. And every once in a while you get stuck with something. Well, I guess I'll be holding on that for 3 or 4 years. And then, and whereas at least the stock market, I can press a button and I'm out of $1 million in my portfolio in a second. It's just fascinating. So to me, it is going to be tricky to really get some of those commercial properties that high. It's kind of sad in the sense you look at it saying, I know that's a really good buy. But on the other hand, what are you going to make out of it? And if it doesn't rally far enough, and then for some strange reason that super cycle at the end of the decade comes in there earlier than I anticipate, comes in at the end of the decade instead of next decade, now maybe it goes even lower still, So be a bit cautious. The same thing with large homes. Also dial in the higher interest rates. Someday that will work against real estate. At first it shouldn't. It can, but it really shouldn't, because normally interest rates go higher right after a recession, and it's normally a good thing. As always with real estate, it does boil down to location, and you got to pick it a little more careful than what you might do in other types of investments. But I like what I see on my indicators, at least, which may only be showing me a certain portion of the real estate. I may not realize it, but my indicators are looking optimistic, but they're not necessarily saying this is a fantastic.
Well, Rich, talk a little bit about your Critical Point podcast, where they can find it, what they're going to find on that podcast.
Sure. So they can find it at criticalpoint.podbean.com. And what they'll find is it's just a very simple site. I got tired years ago of I used to have 5 websites, and there was just so much stuff on them. This is just a list of basically videos, some audios. Most of the audios are really, I'm just doing it on my cell phone, and it's just a quick little update or some kind of informational piece for anybody, everybody. The videos is what you want. And when you click on a video, sometimes a little difficult to see. Somewhere's on there, I'll be a little smaller print that's saying it's a premium service. And what that means is I've locked that video up for my paying subscribers, and you need to click on it and pay for it. It's just a monthly recurring fee. It's quite cheap. It's only $27.99 a month. But I don't write a newsletter. I don't throw out big tables and databases. I don't and I don't want to take a lot of your time. I want to show you on a chart what those signals did in the past. How did everything fluctuate? My guess is it will raise confidence. You'll say, okay, I'm waiting for that next signal. And then I'm going to show you on that chart and quite possibly even send out an alert saying, buy corn, sell the stock market, things like that. And I look at the stock market, the economy. I look at a variety of financial markets, a little bit over in the gold, dollar, and some of the energy, but it's mostly geared towards the grains, stock market, economy, and then I love to play with the weather a bit as far as a weather risk. They can also find me on Twitter at Rich_Posson, and they can also direct message me there. They can email me at rich@ag-financial.com. More than happy to have some conversations and share some ideas here. And get on board and try it. If you don't like it, you just stop paying, right? It's like, and to me, as I look at the quality of the signals, I run a very high retention. I'm very thankful of here at the first of the year, you could see some people wanted to get started for the year and suddenly had a nice bump in subscribers and followers.
Yep.
And
yep. So yeah, good stuff, folks. Go check that out. I listen to it. There's a lot of good stuff on there. A lot of things I don't understand because I'm just an equipment guy. But Rich does a really good way of explaining things how how they work. So, Rich, anything else you want to make sure we touch on before we shut the podcast down?
No, I think that pretty much caps it. We'll see where next week on the economy side, we'll get some PMI indicators, kind of tell us how things went in January, and they may back off a bit because I do think the virus made a little bit of impact going into the end of the year. But I also tell myself normally in winter the economy does ease off a bit, so I'm not too concerned about it. I think things get better later in the year.
Right on. Okay. Well, Rich, looking forward to it. Looking forward to getting back together with you in February, talking about what's going on then. And thank you for being on the podcast, man.
Thank you.
All right. I'm Casey Seymour with Moving Iron Podcast. Make sure you check me out on Facebook, Twitter, and Instagram. That's where you're going to find all the posts that I put out there for the podcast and any blogs I have to post as well. Also, go to MovingIronLLC.com, and you can get all the information you need to have for the Moving Iron Summit coming up in Nashville, Tennessee on September 15th through the 17th. So if you're an equipment dealer of any kind, reach out to me. It's open to anybody that wants to come to that. And it'll be a great deal. If you want to check out Rich and what he looks like as well as what his bio is, go to the Moving Iron Podcast page. Go down to Moving Iron Podcast contributors, and you'll see myself and you'll see Rich in there as well. So with that, I am Casey Seymour with Rich Posson. Let's go move some iron, folks. Out. You want to have a meaningful competitive advantage to help sell more equipment. Whether you represent the sales, parts, or management department of an implement dealership, there's a surprising amount of complexity when it comes to tire, wheel, and track technology. Let Axon worry about that so you can get back to supporting your customers. Axon has leveraged years of experience to create a streamlined process that gives you a proven path to help today's grower and sell more equipment. The roots of their organization go back almost 100 years to the invention of the rubber tractor tire. Supporting agriculture is the number one driver of Axon from product development through sales and service. To find more or become an Axon dealer, head over to axontire.com.
Moving higher in the 21st century. Hard-working people working hard for you and me. Moving higher, time and time again. Through the years you'll find us here. Moving higher.